Good day, everyone. My name is Bert Salazar, and I am going to be your host today. Welcome once again to our webcast. And today we're doing part 2 of the IRS taxable buckets. As you all know, last week we did part 1, which is the understanding the pros and the cons of the taxable bucket. Today we're going to be doing the pros and cons of the tax deferred bucket. Now, for those of you that are joining us for the first time, please bear in mind that when it comes to the IRS code, there are 3 major buckets that we need to pay attention to. And that is your taxable bucket, your tax deferred bucket, and then next week, we'll talk about the tax-free bucket. Now, when it comes to the different buckets, it is critical to understand how these buckets work, because a better job you do in understanding how the buckets work, the better job you're going to be doing in minimizing your tax liabilities, not only now, but also in retirement. Now, just to give you a quick recap, in the taxable bucket, which is the one that we covered last week, the money that goes into the bucket is after tax. The money gets taxed, the growth on that money gets taxed every year. And then you pay an additional tax upon distribution. So from a taxable standpoint, the taxable bucket is not a very efficient bucket because of the fact that you're putting in after-tax money, you're being taxed every single year, you have no potential growth without any taxes, and then ultimately when you liquidate the account, you may have to pay an additional tax as well. Now, some of the vehicles that fit into that bucket would be your CDs, your money market accounts, your traditional savings accounts, also your traditional mutual funds and so forth. But although that bucket is not very exemplary from a tax perspective, it does provide a tremendous amount of liquidity, and all of us need liquidity in our lives. Now, because of the tax ramifications of that bucket, there's a right amount of money that you must be able to keep in that bucket at all times, because anything above that then will create some additional tax liabilities that you can avoid if you understand how these buckets work. Now, today, we're going to be discussing the pros and the cons of the tax deferred bucket. Now, the tax deferred bucket is the bucket where the money that you put in is pre-tax. The money grows tax deferred. And then when you pull the money out, you're going to be paying taxes on the whole thing. Now, most Americans have an understanding, although it's minimal understanding based on the type of work that I do with many of my clients, but they do have an understanding of the tax deferred bucket because that's the bucket that keeps your 401ks, your IRAs, your pensions, your deferred compensation programs, your SEPs, simplified employee pension if you happen to be self-employed. So most Americans have a tendency to put a lot of money in that bucket. As a matter of fact, they put way too much money in that bucket from a business and taxable perspective. Now, the goal of my firm is not only to provide you information, but also to provide education. Because one of the big sayings that I say on an ongoing basis, and I say just about every time that we do either a podcast, a webcast, or a webinar, is that information without education always leads to failure. So today I wrote a bunch of lines, a bunch of notes that I'm going to be covering with all of you here when it comes to the tax deferred bucket, because the better you understand this bucket, the better your decision-making process is going to be at some point in time in the future. Now, why is it so important to understand the taxable buckets? Well, number one, you want to be able to manage your tax liabilities efficiently. So if you have a clear understanding of how the taxable bucket works versus the tax deferred bucket versus a tax-free bucket, the better job you're going to be able to do in the very near future when it comes to addressing your tax liabilities, not only now, but also in retirement. Now, again, the more you understand how the buckets work, then you're going to have a much better opportunity to reduce your tax liabilities at some point in time in the future. So what I like to do now is I want to get into the pros and the cons of the tax deferred bucket. So obviously, let's go ahead and start with the pros. Number one, some of the advantages is that you have a systematic growth of your assets in your retirement accounts. And the reason for that is when you start making contributions to either 401k or an IRA or any other type of retirement account, you're making those contributions and you're putting monies into those accounts for the long term. So you're going to have that systematic growth. Now, obviously, there's always going to be volatility, but you hope that the growth may offset the volatility at some point in time in the future. Now, if you happen to work for an employer, and this employer provides you with a 401k, and in addition to that, the employer gives you a match, then obviously that's free money, that's additional money that is coming into you on an annual basis based on a percentage of your contributions to the account. So that's another advantage. Now, obviously, you also have the advantage of the tax deduction during the contribution stage. So as you're putting money into your IRAs and your 401ks, you're going to be deducting and taking a tax deduction for the amount of contribution. Now, that could be a good thing, or that could be a bad thing, as we will discuss in the next few minutes. But at least for on the advantages side, or on the pros, then the fact that you're taking a tax deduction today may be a good thing to you. And last but not least would be the pros of the tax deferral. So that means that as your money is growing, you are getting a tax deferral, meaning you're not paying taxes on that growth every single year as you would have had you put the same amount of money in your taxable bucket. So when you factor all those things, then many a times it does make sense to put a certain percentage, and we'll talk about those in the next few minutes, in your tax deferred bucket, as well as your taxable bucket from a business perspective. Now, we should now get into the cons. We should get into the disadvantages of the tax deferred bucket. And the challenge that I have with many clients is that they only pay attention to the pros of the tax deferred bucket. They don't pay attention to the cons of the tax deferred bucket, which may be very, very detrimental to many of you, not only now, but also in retirement. Number one disadvantage is that, you lose what I call the 3 C's. You lose the care, custody, and control of that bucket. Pretty much when you're putting money into an IRA or into a 401k or a similar retirement account, you're basically entering into a partnership with the Internal Revenue as far as it comes to managing that account. Now, guess who the senior partner is? Guess who the managing member of that partnership is from a business perspective? It is always the IRS. So you have a tendency when you put money into these accounts to lose the care, custody, and control. Because in order for you to take money out of those accounts, you have to ask for permission and/or pay penalties along those lines unless you do it the proper way. So losing your ability for the care, custody, and control of those assets for business opportunities and so forth is a major detrimental factor when it comes to tax deferred account. Number two is getting all of you to understand that there's a major difference between tax savings versus tax deduction. And this is an argument that I see often, that, when you put money into a qualified plan, i.e. an IRA or a 401k, you're saving money on taxes. You're actually not saving a single dollar of tax. All you're doing is you're postponing the tax. So you're taking a tax deduction today in order to pay it at a much later time in the future, where it might make sense, but most of the time it's not going to make sense for the vast majority of you. So get a clear understanding that when you put money into a 401k, you are not taking, you're not doing any type of tax savings. Now, some accountants out there and tax preparers may say to you, you know, you may want to maximize your contributions to an IRA or 401k this year because of the fact that you're going to be saving money on taxes. That's totally erroneous. You're not saving a single dollar in tax. You're actually postponing the tax. Now, I always think that, you know, tax preparers are not tax planners. They're only looking in the rearview mirror. So their job is to see how much they can reduce your tax liability for the year that you are filing and that you're visiting with them on. They're not looking forward. They're not doing any type of tax planning for you. That's one of the major differentials of what tax preparers do in the marketplace versus what we do in our firm, which is a combination of tax preparation and tax planning along those lines. Now, also remember that when you are postponing the tax, you're actually postponing the tax liability. And then obviously the tax liability may be a lot greater in the future, because a big question that you need to ask yourselves whenever you put money into one of these tax deductible accounts, or whenever you put money into the tax deferred bucket, the major question, the only question that you should be asking yourselves is, where do you think the taxes are going to be in the future? Where do you think that you're personally going to be in the future from a taxable standpoint? Now, when we take a look at this, at our country today, and you take a look at the fact that we're almost at $22 trillion and counting when it comes to the national debt. Also, when you take a look at the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, it actually exceeds $115 trillion a year. And when you also look at the deficit between the revenues that are coming in today versus what we are paying out, we're almost at $1 trillion in deficit on an annual basis. Then obviously you have to be able to do the math. And the math is, you know, how is this country going to be able to fulfill all of those obligations in the future? And I'm not talking about 30, 40, 50 years down the line. I'm actually talking about 10 years down the line. So we all know that the tax liabilities in the future are going to have to be a lot higher than they are today because of the fact that we're going to have to pay all of these liabilities, and we don't have the money to pay it today. Now, an unfunded liability basically means that these are liabilities and promises that the U.S. government has made to all of you, all of us, including myself, that they don't have the money to pay for today. So by raising taxes and by raising tax liabilities for all of us, the government may be able to offset some of those tax liabilities, although they're going to have to do other things, especially when it comes to Social Security and Medicare in the future. They may have to do a straddle. They may have to do a combination of raising taxes, reducing benefits, encouraging Americans to delay retirement or forcing delay retirement upon Americans in the future. And that's going to come with a big price that all of us are going to have to be able to pay at some point in time in the future. Now, remember I said that whenever you put money into a tax deferred bucket, you're entering into the partnership with the IRS from a business perspective. And the reason to understand it is that, you know, what belongs to the IRS always belongs to the IRS. What do I mean by that? Well, let's say that you're making $100,000 a year and you happen to be in the flat marginal 30% tax bracket. I'm just using 30% to make the math simpler for all of you. So you're making $100,000 of income. You want to put away into your 401k $10,000 for the year. Now, had you not deferred or put that money into the tax deferred bucket, those $10,000, then you would have paid $3,000 in taxes to the IRS. 30% of $10,000, you would have given the $3,000 to the IRS, and then obviously you would have kept the other $7,000. But because of the fact that you enter into a partnership with the IRS, and the IRS allowed you not to pay them the tax today, but to delay that tax and that tax liability to sometime in the future, then you're actually putting the $10,000 in your 401k from a business perspective. Let's say that that $10,000 grows to $100,000. And, 10, 15, 20 years from now, you want to liquidate that account. Remember, what belongs to the IRS will always belong to the IRS. So the IRS loaned you originally that $3,000 of the $10,000 that you should have paid them, but they loaned the money to you. So that $3,000 inside of that account, that 401k that you put in, along with the $7,000 that you contributed for a total of $10,000, that $3,000 and the income that the $3,000 generated will always belong to the IRS. So if you're still at the 30% tax bracket, when that $10,000 becomes $100,000, guess what? $30,000 will go in taxes to the IRS, and you will then keep $70,000 in your account. So the ratio is going to be pretty much the same the vast majority of the time. The only question to you is, if taxes were to go up 1%, just 1% over the next 10, 15, 20 years, then you would have been better off to have paid the taxes today as opposed to waiting 10, 15, 20 years from now in order to pay. Also, we need to address that under the Tax Cuts and Jobs Act of 2017 that was signed by President Trump into law, we actually have an 8-year window in which to be able to maximize our tax planning. As of January 1 of 2018, the standard deductions have actually been increased for all Americans. By the same token, the tax brackets have been reduced for all Americans. So you have an 8-year window in which to be able to do proper planning, not only for yourself, but also for your family as well. And the reason why it is only an 8-year window is because these new tax laws and the new tax benefits sunset on December 31st of 2025. That means that they end on December 31st, 2025. So January 1 of 2026, everything goes back to the old law that we had in 2017, in which the standard deductions were lower and your tax brackets were higher. So automatically there's going to be a tax increase January 1 of 2026. I'm mostly concerned though not necessarily on January 1 of 2026, but January 1st of 2028, 2029, and 2030, because that's when the major impact for Social Security and Medicare is going to hit Americans and the U.S. government from a business and economic perspective. So taxes are going to have to be much, much higher in the future in order to be able to offset those tax liabilities. So having a clear understanding on how to manage these taxable buckets, it's going to save you, your family, and your business tens of thousands of dollars every single year for the rest of your lives. Now, the other disadvantage that you have is lack of liquidity. And that's a major problem because it doesn't give you the ability to maximize your business opportunities. Let's say that you would have the ability to pick up a piece of property. And if you need to pick up a piece of property, if you're going to go into one of these accounts, then you're going to have all kinds of rules and regulations that you're going to have to abide by in order to avoid penalty. Now, the first rule that you should all be aware of is the 59.5 rule. See, the fact that you enter into a partnership with the IRS and the fact that they allowed you and they loaned you that tax liability to you in order for them to receive it in the future, then that means that they're going to place certain golden handcuffs on you and your business. Number one, they're going to say to you that if you take any money out of these plans, IRAs and 401ks and SEPs and so forth, prior to age 59 and a half, unless you happen to meet certain exigent circumstances, then not only are you going to have to pay the tax to the IRS, but you're also going to have to pay them a tax liability, which is equal to 10%. So that is one of the major handicaps that you have inside of the tax deferred bucket. Now, the second rule that you need to be aware of is what is known as the RMD rule, the required minimum distribution rule, which means that by the time you get to the age of 70 and a half, whether you want to or not, the government is going to force you to take money out of these plans. And if you fail to do so, then your failure to do so will turn into having to pay taxes on the amount of money that you should have taken out of these plans, but you didn't. And on top of that, you're going to have to pay a 50% penalty, excise penalty, on the fact that you failed to take a distribution when you should have under the IRS code. Yes, a 50% penalty. Now, when it comes to required minimum distributions, it is a major challenge for the vast majority of Americans. And this is why I was telling you at the very beginning that most Americans understand the pros of putting money into a qualified plan, but they don't understand the cons of putting monies into their tax deferred buckets, whichever buckets they may want to put the money into, depending on the product that they're getting. And the reason for that is that the IRS basically says that you must start taking distributions out of the tax deferred bucket once you hit the age of 70 and a half. Now, they give you a couple of rules. Number one is in the first year, if you turn 70 and a half in 2018, then you can take that required minimum distribution by December 31st of 2018, or you can delay the distribution to April 1st of 2019 if you happen to turn 70 and a half in 2018. Now, the decision whether to take that distribution in 2018 versus 2019 comes with a tax planning approach. And unless you're dealing with a tax preparer that understands tax planning and has the software to be able to identify whether it is more suitable to take the 2018 distribution in 2019 or vice versa, then the probability that you're going to be able to make a mistake when it comes to retirement required minimum distributions is going to be a lot higher than if you have the tax planning software to be able to do that. Now, the decision is simple. If your tax liability in 2018 is going to be lower than in 2019, then it may make sense for you to take your 2018 RMDs in 2018. But if you feel that your tax liability will be lower in 2019, then you may be able to delay that distribution until April 1st of 2019. Bear in mind that if you delay the 2018 distribution until April 1st of 2019, then in 2019, you will be forced to take 2 required minimum distributions. The one for 2018 that you must take by April 1 of 2019, and then you have to take the 2019 distribution by December 31st of 2019. So depending on where your tax liability is going to be, you have to do proper due diligence, you have to do your math, and you have to identify future incomes and liabilities in order to determine what would be more suitable from a taxable perspective to you and your family along those lines. Now, obviously, the other major issue, and we're seeing this today, we have a tremendous amount of stock market volatility. Most of the clients that I deal with and most of the Americans that I deal with that put money into their retirement accounts are actually investing those monies into traditional investments accounts like stocks, bonds, and mutual funds and the like. What they fail to realize is that inside these accounts, you cannot take a tax deduction for any losses. So I remember back in 2008, when your 401ks and the 401ks of millions of Americans became 201ks because they lost 50% of their money in those accounts, they could not take a tax deduction because of those losses like you would in a traditional stock that you may own outside of the tax deferred bucket. So here's a question that all of you need to address. And this is more of a, how risk averse you may be in the future. If you cannot take any deduction for any losses that you're going to have in your retirement account, why would you want to be so aggressive in your investments into those accounts? If you cannot take a deduction for any losses that you may incur out of these accounts, then where are your tax benefits from that perspective? Also, the other question that you need to ask yourselves, and this is a question that I ask each and every one of my clients on an ongoing basis, is what is your true rate of return in your tax deferred bucket after you factor in inflation, taxes, and market volatility? The vast majority of Americans that I deal with on a regular basis are not able to tell me what their internal rate of return has been in those accounts, IRAs and 401ks, since inception, since they started to put money into those accounts and or opened those accounts many years ago. So if you really don't understand what your internal rate of return is, and you don't understand, how all of that is going to compare when it comes to retirement distribution planning at some point in time in the future, why would you want to take so much risk for investments that you don't know what your rate of return is today and or what your rate of return may be in the future due to taxes, inflation, and market volatility? Now, the other issue to consider is, why take that loan from the IRS today into the tax deferred bucket? Because at the end of the day, if I come to you and I say, look, I own a bank, I'm willing to lend you $100,000. You don't have to pay me at this point in time, but at some point in time in the future, I'm going to come back to you and I'm going to demand that you pay me the money back. And on top of that, at that point in time, I will determine the interest rate that I'm going to be charging on that loan that I gave you 10, 15, 20 years ago. How many of you would actually cash that check that I would give you as a loan? I would argue that none of you would. But by the same token, we're all doing those things when it comes to the tax deferred bucket along those lines, and we do it every single year because we don't know what the tax liability is going to be at some point in time in the future. And for those of you that think that you're going to be in a lower tax bracket, the only way you're going to be in a lower tax bracket in retirement is if you happen to be a financial failure. Because even if taxes were not to go up in the future, the fact that a lot of your tax deductions are going to go away at some point in time in the future may actually increase your personal tax liability. So your mortgage deduction may be done away with by the time that you retire. Your charitable contributions may be quite reduced because you're no longer employed, so you may want to be giving more of your time as opposed to donations. And by the way, your time is not tax deductible under the IRS code. And on top of that, you're not making contributions to your qualified plans or to your tax deferred bucket, so you can no longer take those deductions as well. So even if taxes were not to go up in the future, there's a high probability that your tax liability, if you've done a decent job with your finances and your retirement, will definitely be going up in the future from a business perspective. Now, provisional income calculation is another major problem that we have with the tax deferred bucket. And what do I mean by that? Well, when you retire and you start taking your Social Security benefits, if 100% of all your income in retirement came from Social Security benefits, and you would not have to pay any federal income taxes on that income whatsoever. The taxation of your Social Security benefits, it is not based on the Social Security benefit that you receive itself, but it's on all the additional income that you may have coming to you once you're in retirement. So, for instance, if you have a part-time job, those W-2s and 1099s will get to be added onto the provisional income calculation in order to determine what percentage of your Social Security benefits are going to be taxed in retirement. What if you're taking money out of your monies out of your tax deferred bucket? Let's say you're taking money out of your 401ks, your IRAs, all of those monies that you're taking out are going to be added on to the provisional income calculation, again, in order to determine what percentage of your Social Security benefit will be taxed in retirement. What else is taken into consideration? Any capital gains that you may have, the sale of a property or stock or whatever it may be in the year that you're filing your taxes, that will be added on to the provisional income calculation. And then last but not least, any income that you generate from municipal bond funds. Now, I know some of you may say, well, Bert, isn't it true that if I take income from a municipal bond fund, I'm not going to have to pay federal income taxes on that income? The answer is yes. But although that is the case, municipal bond funds are not truly exempt from taxes under the IRS code, because that income, although you did not pay any federal income taxes on that income will be added on to the provisional income calculation in order to determine what percentage of your Social Security benefits will be taxed at some point in time in the future in retirement. Now, one thing to consider is the following. If you have to pay taxes on your Social Security benefits, there's a high probability that you're going to run out of money anywhere between 5 and 8 years sooner than if you didn't have to pay taxes on your Social Security benefits. The reason for that is simple. If you have to pay taxes, $3,000, $4,000 in taxes out of your Social Security benefits to the IRS, that is $3,000 or $4,000 that you have less coming into your personal economy. So you may have to dip and take more money out of your IRAs and your 401ks in order to offset that difference. And by taking additional money out of those accounts, that's also going to increase your tax liability, and it's going to accelerate the depletion of those assets in retirement quicker than if you didn't have to pay taxes on your Social Security benefits. So understanding how the tax deferred bucket works is very critical for all of you, because a vast majority of Americans are putting way too much money in their taxable bucket and their tax deferred bucket. What is another major disadvantage with the tax deferred bucket? Well, another major disadvantage is the fact that if you take too much money and you have too much income coming in out of your taxable bucket and your tax deferred bucket, then your Medicare premiums in retirement can substantially go up in retirement. So understanding how your tax deferred bucket works, it is quite critical and it is paramount in truly managing your tax liability in retirement, because is not only the taxes that you're going to pay on the IRA distributions and the 401k distributions out of those personal accounts that you have, but it is also the negative impact that those distributions will have on your Social Security benefits and on your Medicare premiums in retirement. And I would argue that the vast majority of you listening to this webcast today have never, ever taken this into consideration. I would even argue that the vast majority of your tax preparers and also your financial advisors, those that you're dealing with, have never had this conversation with any of you prior to you listening to this webcast today, and also for the benefit that you may incur from the listening of this webcast in the future. Now, I just want to close it by giving you some final thoughts. Number one, you want to limit the amount of money that you're going to place in your taxable bucket, as we spoke last week, and also your tax deferred bucket. And by the way, although there are a lot of negatives to putting money into your tax deferred bucket, I do recommend, and I do talk to my clients about putting money into the tax deferred bucket on an ongoing basis. The difference is that we're not just making blind contributions to the tax deferred bucket. We use net present value calculations in order to determine the perfect amount of money that you should have in your taxable bucket as well as a tax deferred bucket. And the reason why I say that is that if you have the right amount of money in the tax deferred bucket, I have the ability through my software program to allow you to take money out of your tax deferred bucket and the taxable bucket and be able to not have to pay any type of out-of-pocket tax, because we're going to use an offsetting technique that I use with many of my clients that take into consideration your standard deductions and credits and so forth, so you can avoid the tax liability out of those distributions when it comes to retirement at some point in time in the future. Also, when it comes to making contributions to your qualified plans, i.e. 401ks, you should contribute up to the match and no more, because there are many other places. And next week, we're going to talk about the third bucket, which is the tax-free bucket, which is the least understood and used bucket in the IRS arsenal of the taxable bucket, the tax deferred bucket, and the tax-free bucket. And you're going to be amazed as to the capabilities that the tax-free bucket has in comparison to the tax deferred bucket and the taxable bucket. But at least when it comes to your 401ks, you should put money into your 401k up to the match, so you can get 100% of the match, and no more than 7% of your income. Anything above that, there are many other places that you can park your money, not only for the short term, but also for the long term, while maximizing your tax benefits and minimizing your tax liability along those lines. Now, obviously, by doing provisional income calculation, it's going to assist you again in maximizing your income in retirement. But unless you have the ability to do tax forward planning, then there's a very high probability that you're going to get to retirement age, and just about everything that you have will be either in the taxable bucket or the tax deferred bucket, and then it will be too late for you to do any planning. Remember, we have an 8-year window in which to be able to maximize those benefits, and then we'll figure out what tax liabilities are going to be 10 years from now in order to see how we start to create distributional straddles that will reduce and or eliminate your taxes in retirement totally. By the same token, once you reach your adequate limit in the amount of money that you should have in your taxable bucket, as well as the tax deferred bucket in which we're discussing today, then just every other dollar that any other disposable income and or disposable dollars that you should have would definitely be apropos to put those dollars into the tax-free bucket. And we're going to be spending some quality time on the tax-free bucket next week. Now, obviously, there are many things that you can do out of your tax-deferred bucket. You can do IRA conversions in order to reduce that tax liability in the future. You can also do Roth IRAs and Roth 401k contributions if your employer gives you the ability to put money into a Roth 401k, because we're actually living in the third lowest tax bracket from a historical perspective in the history of the IRS code since 1913. So I would rather pay the tax today because I know where it is. as opposed to hoping that my tax liability and that the IRS code is going to do a very good job for me in the future, where we all know that the tax liabilities in the future are going to have to be a lot higher than they are today. Now, I want to offer you what I call a tax planning offer. And this is something that I do for all my clients because it's part of the package that we provide to all of you. Number one, you could have what is known as a customized tax preferred retirement blueprint. And this is a package program that we offer to all our clients, which is going to take all of these issues and concerns that we have discussed between the taxable bucket, tax deferred bucket, and tax-free bucket, and is going to put it all together for you. Now, the first thing that we do is, if you have the need for tax preparation, we'll be able, as part of this package, to offer those services to you, your family, and your business. By the same token, we have the ability to do tax forward planning. Not only are we going to be able under this package to offer you tax preparation for the current year, but we will offer you tax planning reporting for the following year and 4 years or 5 years down the line. By doing tax forward planning, you now have the ability to mitigate your tax liability in the future by doing proper tax planning today. Remember, there's a big difference between tax preparation and tax planning. Tax preparation occurs between January 1 and April 15th. Tax planning is something that you do for the entire year. And if you do a good job, you actually do tax forward planning in order to minimize your liabilities in the future from a taxable perspective. The third report that we do as part of our customized tax preferred retirement blueprint is a Social Security benefits report. The Social Security benefits report actually tells all of us, all of you, what would be your optimum time to trigger your Social Security benefits. And on top of that is not only the triggering of the Social Security benefits, but also the comparison of those benefits versus all of the other assets that you may have in your portfolio. And most important, the impact of taxes on those Social Security benefits and which one may be more apropos for you. Sometimes it is better to start taking Social Security benefits earlier in retirement than having to wait till age 70, hoping for a bigger Social Security tax payment without having a consideration for the tax liability that may be impacting that higher Social Security payment to you in the future. So the reporting that we do under the customized tax preferred retirement blueprint offers you the ability to understand what would be the optimum way to do it. The next report that we do as part of our customized tax preferred retirement blueprint is a retirement distribution report. And what this retirement distribution report does is that it gives you the ability to take a look at all of your assets, look at them through a telescope as opposed to a microscope. The view is totally different. And then we create a distribution planning report in order to determine what assets we're going to be distributing first, what percentage of those assets are going to be distributed from 1 year to the next, what are the tax liabilities of those assets, how can we eliminate those tax issues in retirement by creating distribution straddles that will maximize the tax code as we move forward into the future. And then last but not least, the last report that we do for you is a Fatal 4 report that addresses the 4 major issues that may hinder your retirement life and that of your family, which is the risk of dying too soon and the impact that that would have on your entire family, the risk of living too long and the impact that living too long may have on all your assets, because at the end of the day, you don't want to run out of money before you run out of life. The third Fatal 4 report is the issue of living with a disability. Because of the fact that people are living a lot longer today, they have a higher susceptibility to experiencing some kind of a critical illness and long-term care that may have a negative impact on retirement assets. And then last but not least, number 4 of the Fatal 4 is the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, lawsuits, and all of those negative issues that unless you have the ability to look at your assets through a telescope, you would not be able to see those negative impacts through a traditional microscope. So again, if you want to have access to our customized tax-preferred retirement blueprint, please feel free to reach out to me regarding the customized tax-preferred retirement blueprint package, or any other questions that you may have relating to this webcast. And you can reach out to me. Again, my name is Bert, B-E-R-T, Salazar, S-A-L-A-Z-A-R, and you can reach me at 786-766-1042, or you can send me an email at Bert, B-E-R-T, at GablesTaxGroup.com, and I will be more than happy to answer any questions that you have. As I always say at the very end of every webcast, my number one goal and that of my firm is to kind of help all of you change the way that you see things. Because when you change the way that you see things, the things that you see change. Again, thank you, and I look forward to talking to you again next week. Take care. Bye.